After learning this, never have I been so sure that a housing market crash is going to happen. During the past few months, I've been pretty sure that a housing market crash is going to happen, but now after learning these new details, I'm confirmed it definitely is. In this video, I've got a bunch of information, news and data to show you and prove to you that there are huge risks building in the housing market, in the stock market and the economy overall. Right now, house prices are booming. The media's putting it out all over there. That's boom, boom, boom. You got to get in now. FOMO's at all-time highs. People are paying whatever price to get a home, but unfortunately, this is going to end very bad. In this video, I'm going to go over some new details about the housing market, which includes the IMF warning that there's a risk of overheating in the housing market in Australia and in the US. How people overpaying for properties now is going to lead to a crash in the future. I'm also going to go over why critics are slamming the Federal Reserve, what they're doing to overheat the housing market, and how there's more pressure on them to reduce their quantitative easing and purchasing of mortgage-backed securities. I'm going to go over a tsunami of forbearance and mortgage holidays that are coming to an end, which is going to lead to more stock on the market. I'm also going to go over how mortgage rates are increasing rapidly. I'm also going to go over what you can do in this housing market right now, what this means for you, and how we can prepare for what's coming. Okay, first things first, I'm going to go over some new information I've just found out and some new news in the housing market. And once I saw this, I'm like, okay, a crash is definitely coming. Home buyers right now are actually stretching their budgets. They're overpaying for properties and they're actually overpaying even what the bank is willing to lend them. Have a look at this. Home buyers stretch their budgets to avoid asking for more cash later amid a rising property market. And this is what's really worrying me. He says, people are going to auctions and they're actually bidding $50,000 over what the bank is willing to lend them, and they're now saying, okay, I've got a month to find $50,000 or I'm going to lose the house. Everyone, if this is not screaming housing bubble, I don't know what will. And how this is going to affect the housing market in the future is these people, they're not paying market value for a house. They're going to auctions or they're going to home inspections, and there's a lot of ego and there's a lot of emotion in the housing market. It's not like the stock market. People get very emotional with homes. I also do get emotional with stock market, but more with homes when they see something they have to have, when they think of their dream home, when they think of their family home, they get emotional, and right now they're paying much more than what homes are worth. And why this can trigger a crash is because if people are paying 20 to 30% over what the house is worth right now, when interest rates are at all-time lows, when the FOMO is taken out of the market late this year, when all the stimulus is taken away, when interest rates rise, and when interest rates do rise, people won't have those budgets to bid up 30 to 40% over asking price for houses, then that means a house is only worth what someone is willing to offer. So if people pay 20 to 30% over market value, then next year when they go to revalue their property and appraisers are more conservative, they're going to appraise a property 20 to 30% less than what they paid for. Have a look at this. A large number of buyers are going to auctions with their financial capacity already at the limit because they know they've got to stretch prior to auction to be confident they can buy at the stretch price. I'm extremely worried about this. This is sending alarm bells. People are stretching themselves to the T, and guess what? If they're taking what the bank says they can afford, the max what the bank says they can afford, the banks always offer more than you can afford in most cases. I remember when me and my wife first got married and we first went to the bank to see how much we could get approved, they were willing to offer me twice what I could afford to pay. And most people, unfortunately, they're not financially savvy, they're not good at sticking to budgets, so the bank says, hey, we can lend you $700,000. They won't even know what their monthly budget is, and they're not even sure how much the extra costs are going to be, like council rates, property taxes, insurance is rising, water rates, and maintenance, and much more. So what this is going to lead to is a bunch of people FOMOing in saying, look, I'll figure it out later, I just got to have it now, because people don't have any patience anymore. You're seeing the buy now, pay later thing boom. People want it now. They don't care about how much debt they're going to get in. They don't care they're going to default down the road. They just got to have it now. This is going to lead to forced sales as interest rates rise. And what mortgage brokers are now saying that their clients are doing, they're coming to the brokers and they're going to the banks and saying, look, house prices are going up much more than I thought I could. I need to borrow more. And this is just going to be a disaster. And this is happening in Australia, in the US. I've got a lot of viewers in Canada and the UK. I know in Canada, this is happening as well. All your viewers in the UK, I think it may not be as worse there, but comment down below what's happening in the UK. But don't go anywhere. I've got heaps of more data and news that proves that we are getting to the peak of this bubble and the danger is just around the corner. Have a look at this. mortgage firms are warned to prepare for a tidal wave of distress. This is happening in the US with forbearance, and this is also happening in Australia with mortgage holidays coming to the end. And it's pretty much globally, all the banks around the world, they let customers not pay their mortgage for 3 months, then it was 6 months, then it was 9 months, then it was 12 months, and they just keep on extending it because the banks know this is going to cause a housing market crash and they don't want it to happen, and they're getting desperate. But unfortunately, banks have shareholders, they need to earn profits to pay their dividends, and what they're going to do is slowly start unwinding these loans. And now that the housing market is booming, we're going to see more banks start telling customers to sell. They'll say, look, it's a booming market, you're going to make some profit, sell your property now in the booming market before things get bad down the track. And regulators are terrified. This is what they said. Mortgage companies could face penalties if they don't take steps to prevent a deluge of foreclosures that threatens to hit the housing market later this year. Everyone, it's all sunshine and rainbows now, but that's because they haven't allowed the natural downturn in the economy and in the markets to happen. But now they're going to start letting it happen as they start quantitative tightening and start withdrawing all the stimulus. Have a listen to this. More than 2 million borrowers as of January had either postponed their payment or failed to make a payment over the past 3 months. The Bureau said once government assistance ends in September, there's going to be hundreds and thousands of people needing assistance or maybe potentially having to sell their home. And in Australia, the Commonwealth Bank has even said they're going to have to start telling some of their customers to sell. But they said, look, it's all good, you're selling in a booming market, so it's probably better that you sell now. But that's not all. Mortgage rates have been rising for 7 consecutive weeks in the US, and banks in Australia, the Commonwealth Bank, the biggest bank in Australia, has also started to lift its interest rates. And with rising bond yields and with the term funding facility by the RBA ending and yield curve control likely to end later this year, and bond yields rising, there's going to be more mortgage rate hikes coming. So have a look at this. Mortgage rates have skyrocketed in the past recent months, adding $33,000 to the average 30-year mortgage. Mortgage rates in the US have gone from a bottom of around 2.65% to 3.18%, and every week for the past 7 weeks have been consistently rising according to Freddie Mac. And like I say, for every 1% increase in mortgage rates, house prices can fall 10% because all these new home buyers that are going out there in the market, they're now having to go out there and compete with high interest rates. And there's a lot of first home buyers that have just given up. It says here, already there are signs that some buyers are calling it quits in today's housing market at the start of 2021. So we are going to see a slowdown because I can tell in the comment section and according to the data, a lot of first home buyers are saying, look, I'm out, this is getting crazy, I'm not willing to pay these stupid amounts for these properties, and I'm not willing to get to my eyeballs in debt just to have a home. And so they're now starting to come out of the market, and that's going to reduce demand and soften house price growth. But have a look at what the Federal Reserve is doing, and it's absolutely crazy, and critics are now slamming the Federal Reserve. And it's not just the Federal Reserve, it's the RBA, it's all central banks around the world. As the economy is overheating, as the stock market is overheating, the housing market is overheating, they're continuing to print money like crazy, and they're continuing their quantitative easing. Guess what? As of last week, the Federal Reserve held $2.2 trillion of mortgage-backed securities. Critics have slammed the Fed and they're saying they're just on autopilot and they haven't even looked at this, and they're just continuing to buy mortgage-backed securities even though house prices are going out of control. Have a look at this chart. As you can see, from 2018, the Federal Reserve started to taper down their mortgage-backed security buying, but the economy is so strong, the economy is so great, the market is so great, the stock market, the housing market is so great. Well, look what they had to do. They've skyrocketed the amount of mortgage-backed securities they've had to buy in record amounts. Guess what? The Federal Reserve now owns a third of the mortgage-backed security market. If this financial system is so sound and so strong, why are central banks around the world having to buy up everything? They're buying up mortgage-backed securities. They're buying up all the government debt. They're buying up all the corporate debt. Soon, central banks may own everything. And the reason for that is because this financial system is broken and it is on the verge of collapse. And pretty much there's water piling into the ship, but the ship is sinking, and the central banks are taking up everything. They're taking up all the water, they're taking up all the debt, all the mortgage-backed securities, all the government bonds, and they're buying up everything, because if they don't, everything will come crashing down. And what this is doing is keeping confidence in the markets, because everyone's like, well, money printer go burr, they're devaluing the currency like crazy, which is true. So I'm just gonna go all in on the stock market. I'm gonna pile into debt in the housing market. and nothing will happen. The Fed will save me, the RBA will save me, the government will bail me out. So risk is at all-time highs, and I'm just gonna do whatever it takes to get that money. I can tell this is a market sentiment by looking at all the financial channels on YouTube and reading the comments, and just generally speaking to people out there in the public. Even people that don't normally invest are all about investing. They're all about stocks and doubling their money, tripling their money, and pretty much they're gambling. They're not just buying stocks, they're buying on margin. Margin debt is at all-time highs. And we're seeing how derivatives and leverage can really crash the markets very quickly, because a lot of the price in these stock markets, in the Bitcoin and even gold, a lot of it is derivatives and it's not actually real. It's just people betting on what prices will do. And as soon as the derivative market goes down, everything else will go down with it. It says here, and I completely agree, the Fed is just afraid to change because they don't want it to be seen as a form of taking the foot off the pedal. And that's right. Like I was saying, as soon as the Fed even mentions that they're going to start maybe lifting interest rates sooner than expected, or inflation is going to be higher than expected, or they're going to start tapering their quantitative easing, bond yields start spiking and the stock market starts selling off straight away, because the only thing that's lifting the stock market right now is quantitative easing and money printing. It's just that there's no other alternative place to put their cash, because interest rates are at zero for now. But as soon as they stop that and bond yields rise, people will start to rotate out of stocks and go back into bonds. And a question they're asking is, why is the Fed doing this? And their question is, could there be a liquidity crisis or crisis in confidence, just like what happened in 2018 with the repo markets, when the repo market spiked from 2% to 10%. And have a look at this. The IMF says that the housing market is at risk of overheating, and they're calling to increase taxes. Also, more people are saying, look what's New Zealand Central Bank doing. They've now increased the loan to value ratios. So investors have to have at least a 40% deposit, and home buyers have to have at least a 20% deposit. And they've now made it that investors can't claim interest on tax. And there's now calls for the same reforms in Australia and in the US to increase housing affordability. So that's just another one of many risks that I think could happen to the housing market. There's going to be more pressure put on governments as housing affordability becomes a big issue. People are going to call saying, stop giving tax credits to these wealthy investors. And if they did do that, well, confidence would fall in the housing market. A lot of investors would sell their investment properties and prices would fall very quickly. I'm not saying they should do that or they will do that, but I'm saying there is an increased risk of interventions by the governments to reduce the tax benefit for real estate investors. This means mid to late this year, there's going to be a lot of distressed properties coming onto the market. Interest rates are going up, which means new buyers aren't going to have as much capital go out there and bid up property prices. People are overpaying in market value, so when they go to revalue their property next year, it will be significantly less than what they paid for it. It looks like central banks around the world and the Federal Reserve are going to start quantitative tightening and start tapering their balance sheets as the economy and the housing market overheats. And like I said, there's going to be more calls to reduce tax benefits for real estate investors. So now I'm more confident than ever that mid to late this year, we're going to start to seeing a cooling in the housing market. And if all these distressed properties do come on the market, if interest rates keep rising, if central banks start tapering their balance sheets, and if these tax policies do come through, there could be a decline in the housing market of 20 to 30% next year. So everyone, I urge you, don't go out there and FOMO and pay $100,000, $200,000 over the asking price, or in Sydney, $500,000, $1 million over reserve. It will calm down, it will cool down. It's just a matter of time. And even for example, if house prices continue to go up 10, 15% over the next 6 to 12 months, well, that may seem great, but then if there's a decline of 30% over the next year to 2 years, well, then you're underwater 15%. For all my loyal viewers and subscribers still watching, you're awesome. I just want to say thank you for all of your support. The channel has absolutely skyrocketed. People are slowly waking up to what's really happening in the housing market and with the financial system, and I'm so happy with the community we're building here. And if you're bored, I'll put up some of my other videos here. I'll see you there.